Ladies and gentlemen, good day and welcome to the Steel Strips Wheels Limited Q1FY25 earnings conference call hosted by Snips Limited. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. And I've handed the conference over to Mr. Amit Hiranandani from Snips Limited. Thank you, and over to you, sir.
Thank you, Neha. Good morning, everyone. On behalf of Snips Limited, I welcome you all to Q1FY25 conference call of Steel Strips Wheels Limited. We are pleased to host the senior management of the company. Today we have with us Mr. Mohan Joshi, Executive Director, Mr. Naveen Sorat, CFO, Mr. Aditya Dixit, President of Exports Division, and Mr. Pranav Jain, DGM Finance. We will start the call with initial commentary from the management, and then we will open the floor for Q&A. Now, I hand over the call to the management team. Over to you, sir.
Is rupees 1025 crore versus 1044 crore in Q1 of FY24. EBITDA is at 118 crore versus 117 crore same quarter last year. Profit after tax stands at 46.20 crore, which remains largely in line with previous quarter despite increase in finance cost and depreciation. EBITDA per wheel for Q1 stands at 257 versus rupees 253 in Q1 last year and rupees 256 in Q4 last year. For the quarter gone by, our revenue mix has been 29% for alloy wheel rim and balance 71% for steel wheel rim business. For alloy wheel, sales volume increased by 1% year-on-year to 7.25 lakh wheel rims. For steel wheel rim, sale volume remains flat year-on-year at 38.67 lakh wheel rims. Coming to export front, Q1 FY25 export revenue stands at 123 crore as against 154 crore for Q1 FY24. Overall export includes rupees 15 crore on alloy wheel business. For current quarter, overall debt stands at rupees 965 crore versus 1047 crore in Q4 FY24, thus a reduction of approximate 82 crore. During the past quarter, our revenue in domestic market are in line with the industry across segments, except 2 to 3 wheeler and tractor, wherein we have outperformed the market. However, in export volumes declined due to multiple reasons, including supply chain disruption and rising global inflation. Through all of this, we expect our exports to improve going forward, and we maintain our guidance of exports to be around 675 to 700 crore. Looking forward, industry reports predict that the automotive industry will grow at a moderate pace due to the release of pent-up demand and the impact of high base effect. Going forward for FY25, we expect 6 to 7% growth in steel wheel domestically. In two-wheeler industry, we have focused on electric vehicle sector, where we are now leaders in wheels, providing significant value addition. This business is expected to grow by about 15 to 17% in FY25. As mentioned earlier, we had concerns on the PV business as margins were lower than expected, but those concerns are getting resolved and we expect a 7 to 10% growth this year in this segment. Last year, we achieved our highest PV volume. This year, we expect flat or marginal growth in line with the expectation of CV industry. In tractor business, we have secured long-term agreements with prominent customers, which should result in a much higher growth of over 10% for FY25. We expect our market share to increase over time in this segment. In aluminium wheels, we are expecting a growth of 12 to 15% with major growth coming from exports. Last year, we introduced a new business line, aluminium knuckles. This will start generating additional revenue from Q3 onwards. This product is primarily for the SUV segment, where OEM has stronger pricing power and are keen to enhance vehicle features like better maneuverability. Going ahead, the automotive sector is poised due to continue its upward trajectory, benefiting from both domestic demand recovery and favorable export conditions, along along with positive monsoon forecast and the festive season as potential growth drivers. We are determined and steadfast on utilizing every available resource to its optimum level for reaping the best output. Steel Strips Wheels Limited continue to remain laser focused on the road ahead and are committed to leveraging every opportunity to drive innovation, deepen our customer relationships, and solidify our position as a leader in the market. With this, we are now open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Sharma from SP Capital Financing Limited. Please go ahead.
Yeah, hi. Good morning. Am I audible?
Yeah, you are audible.
Yeah. So I have a couple of questions. First, I just wanted to ask you about the market share front. In our PV market share, we have market share has gone drastically to 37% sequentially. So can you please throw some light on what is the reason behind it?
See, on the PV side, on the alloy side of the business, I think the market share remains very, very stable. The PV side, on the steel side, there are certain decisions that we took on some of the customers where the margin and the valuation by those products, because they were very age-old products, and I've been clearing that in every conference call, that we left out those businesses 1.5 years back. So from 42, 43 odd percent, we from almost 47%, we slipped down to 42%, and currently we are at 37, 38%, and we are fairly very comfortable with this 37, 38%. We will do this business profitably, and wherever there is a competition, somebody wants to do that business at those prices, we are more than happy, because we'll create that space for exports, we'll create that space for some other products, but on PV side, minimum margin is 1.6 lakh per month to close to 2 lakh 10,000 numbers per month. And this capacity will be added by, I think, Q3 end for utilization for Q4 of this financial year, where CV domestic, what do you call, demand supply scenario is very, very tight. So this relaxation will come towards Q4.
So since the demand scenario is becoming kind of grim right now, do you think the capacity expansion that has happened for a few years from here, it could cause some stress on your balance sheet?
No, I think let's not see CV from month to month. I'm fairly confident that the infrastructure demand which is in the country, along with the compliance rules which are coming from the government in terms of banning the vehicles beyond a certain period of time, will make sure that the demand will take care of 4 to 7% kind of a growth rate. And with that kind of a pace, along with the focus on increasing the product offering to the customers, along with the export territories, we are fairly confident that the capacities will be utilized to the tune of 85 to 90%.
On the alloy wheel expansion front, how is the progress going?
So for this financial year end,
for quite some time.
Yeah. So I think currently, as we updated last time, we were at 3 lakh per month, which is 3.6, and I think that very soon we are going to be moving towards 3.3, 3.4 lakh per month. And towards this financial year end, the plant will be at close to 4 lakh per month, which is 5 million capacity, against which this year's full year projections are estimated between 3.4 to 3.5 million wheels. Next year it is going to be between 3.7 to 3.8 million wheels. So we are in line with the demand supply scenario there also.
Okay, sir. Thank you.
Thank you. The next question is from the line of Rohit from Samatva Investments. Please go ahead.
Good morning, sir, and thank you for the opportunity. So my first question is on the exports market per se. So So if you look the Chinese EV, some of the large players, they've been very aggressive in terms of their penetration in US, in Europe. So do you see that as a threat in terms of electric vehicles, penetrating the export market, which may lead to a slight decline in the demand for alloy wheels right now?
Aditya, can you take this, please?
No, Mohan. I mean, was this with perspective of what China has done in the US and Europe market in terms of their EVs?
Yeah. So my question is, if you look, the largest player today in the EV sector is from China.
Yeah.
In terms of their expansion, they've been very aggressive. And if you're catering to the non-Chinese market, in addition, if there's going to be a penetration of EVs, do you see some risk to our alloy business, which it has just started to pick up right now?
No, I don't think, because the pie is so large. The conventional automakers, I don't see anybody of them having, less aggressive plans than what the Chinese are doing. Yes, the Chinese are entering, but if you see, the US is already putting in duties on them as far as China vehicles coming into the US market. We also expect similar situation in Europe, because at the end of the day, there are so many people working in these American or the European OEMs that nobody is going to, make them struggle so much in their own markets. And we per se are very, very strategically placed with all these American and the European OEMs. European OEMs for sure, because we have had a very encouraging story with them in India, and that's how we have created a pedestal where we are now stepping upon and getting their businesses outside India. So I don't foresee China creating that much of impact so that our exports are going to get affected by this dynamic.
Got it. Just an additional question. So are we doing anything on the EV front right now, on the four-wheeler parts, both in India as well as the export market?
Mohan, you want to take that?
See, for the current space, I think alloy wheel is where the penetration is going to increase, given that EV is an expensive proposition. So obviously, penetration of alloy wheel is going to be a primary thing, which is what we are trying to do currently. On the other side, as we said, that the knuckles business is already underway, and we feel the current penetration of aluminum knuckle is fairly very low, and it's a sunrise industry going forward. The way that aluminum wheels has propagated, we are fairly confident that alloy knuckles will see the similar trend over the next 4 or 5 years, and I think that opportunity for a alloy wheel maker to convert steel knuckles to alloy knuckle will be to the tune of 2,000 odd crores, and we are a part of that. So these two opportunities, which is where we are working. On the steel wheel business, we are already working on the two-wheeler side. So that's where we are having a leadership position, and we are fairly happy with this kind of a penetration into this segment.
Sir, actually, I was asking, are we into the EV part? Are we selling alloy wheels to any of the EV players in India or the export market? I wanted this.
So in EVs, alloy wheel is wheel is an EV agnostic kind of a product. So all EVs will 100% will have EV. So Tata Nexon EV is what we are supplying. We are supplying to the Mahindra EVs also. So wheel does not have a distinction. So if you are supplying to Mahindra the EV wheel, then steel the normal ICE engine as well as EV wheels, we both are supplying there.
Got it. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Chirag Shah from White Pine Investment Management. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, I have a slightly different question. See, when I look at the past interactions, the most result call, we tend to be very positive on the outlook and somehow those outlook doesn't turn out, and every quarter we have to keep on lowering our expectations. So how should one look at your current outlook that you have shared? Yeah, I understand everything is not in your control. It's also a function of how demand dynamics are, but it can't change suddenly every quarter on the downward side. In fact, if I go back to even AMW acquisition, when it was being done, we were under impression that it could ramp up sooner than later. Especially the way that now it seems to be taking a little more time in getting accreditations, customer approval, etc., and also using the plant, either refurbishment or shifting of machinery, etc. So, can you how do you internalize your forecasting or your budgeting so that the downward revisions don't really happen? So that is the first part of my question. I'll come to the next part.
Hi, Chirag. So I'll tell you, there is no change in the volume forecast of the company. There is no change over past 1 year, maybe past 6 months, past 3 months. So first, let me clarify that very, very clearly. So if we were targeting 20 million for this financial year, we are targeting 20 million for this financial year. There is segment-wise some small here and there can happen because, CV goes from +5 to -3 or something. That can always happen. But I think for the full year, in terms of volume growth, we are 100% confident. What we have committed for 20 million, we will hit that 20 million. Second question is that the top line tends to change because of the raw materials, which is not in our control. It is market-driven. And steel prices have gone down by almost 10, 12 rupees, which is on a base of 70, 65 rupees, is close to 15%. So this is also not in my control, and we have to be a pass on, and turnover will, move around accordingly. The third part is AMW. I think AMW came to our lap in the month of, March 2023. And 23, right? I think March 23. March 24, I'm sorry, March 24.
24, I was just going to say
okay. March 24. And the plan was very clearly indicated that it will take 6 months of repairs in the plant to make it functional. So there are two strategies of the business. Whether we run the plant at 10% capacity and run operational loss, that is one side. The second strategy is to take up the machine and add up the capacity in any of the plant which needs the capacity, and a very fraction of capex will be done, and it will turn your asset towards 10x, 15x, 20x asset turn. So we have done the exact same thing. That probably it will take 12 to 15 crores in terms of investments for shifting of these machines from this plant to that plant. And we will run Jamshedpur at a 90% utilization, lowering and improving our economies of scale, and hence improving the margins. Rather than I produce 40,000 in AMW, which has a capacity of close to 5 lakh a month, run all plants and run operational loss. So I think that due credit should be given to the organization to make choices of making maximum of share wealth of the shareholders, right? So we have taken a decision, and we are fairly confident that this capex will increase the top line of the CV business of close to 200 to 250 crores at a fraction of spend of, I think, 12 to 15 crores. And industry is not in my hands. I feel that industry has given a hint of maybe -5%, but I have a hint that the infrastructure spend will continue to grow, it will continue to increase, and we should see a flattish growth for us in terms of volumes if the industry grows by -5. If the industry grows by a little better, we are going to be outperforming the industry any days.
That's fine. The second question was on exports. Now, if I look at last 5 quarters, steel volumes have actually gone down from a peak of 1 million to 0.7 million. And even alloy exports have not really picked up the way we were hoping. So you have indicated some of the reasons, but when I look at bottom up, we were looking to make inroads in certain customers. And because of which we were reasonably optimistic on that. So is there a postponement of product launch from their side, or your SOP from their side, or it is more demand macro dynamics which is driving this? Because
Mohan, should I take it?
Yeah, please carry on.
Yeah. So there are both, aspects to it. One is definitely the demand has come down for some of the steel wheel requirements, and that's purely a market dynamics. As I said, the trailer industry in the US market is still at around 35 to 40% down. But yes, we do see the forthcoming quarters, to take care of whatever downfall we have seen in Q4 of last year and Q1 of this year. Now we do see that a part of recovery happening in the coming 3 quarters. And yes, as far as aluminum wheels are concerned, there have been postponement in the SOPs of certain OEM programs. And it's nowhere a case that we have lost any share of business or any business per se. It is purely the customer has changed few of their SOP dates.
If you can just help us recollect, assuming that SOP now starts whatever timeline that the customer has indicated, what is the ramp up in alloy wheels that we can see from current levels? Whenever the SOP starts, if you can disclose when the SOP starts, it would be great. If you can't, fair point. But what is the jump that we can see in the alloy wheel export if the SOP is on schedule?
So, I'll tell you. One is that in terms of the overall exports for the total year, we still see ourselves in the region of 675 to 700 kind of a number. If you are purely, referring to the aluminum wheels, just a second. So we would still say that we are going to, at least double the aluminum wheels what we had done in the last year. So we see, fair amount of growth in that area, and we are definitely on track.
And would you like to indicate when the SOP is starting?
No, I would like to avoid giving any specifics on that. Yeah.
And just one last question, if I can squeeze in. See, EBITDA per wheel, if I look at, because that is the metric that we as an outsider are aware, not based on tonnage. EBITDA per wheel, how should we look at it? Because it has been stagnating. I understand there has been cost issues on freight rates and all various other things, but from here on, how should we look at it? Because earlier the expectation was that the mix improved. It should inch closer to 300 per wheel over a period of time. So is there a postponement in that aspiration from current 250 odd levels plus minus? So how should we look at EBITDA per wheel as a metric? And what will drive it? Is it pure revenue or there are certain cost leverages? And when do you expect them to play out?
So, Chirag, on your earlier questions, one is on the projections that we have given. I guess what Mohan has clarified, that we have already remained in line with what we have projected for. So even when we look at exports, I guess Pranav has given in his starting statement that for the full year we are still maintaining our guidance that we have given at the start of this year, that we'll be doing closer to 675 to 700 crores. And we are sticking to it, irrespective of what has happened in Q1. In fact, when we have budgeted our numbers for current year, Q1 was already forecasted at a lower number. So we are in and around the Q1 projections that we had for us internally. So there are ramp up, as Aditya has indicated, that there will be a ramp up which we'll see in Q2, Q3 and Q4, wherein this number should see a substantial growth versus what we are seeing today. On the EBITDA per wheel, so if you look at, I guess Pranav in his opening statement has quoted a number of 257 rupees, which if you probably look at the last 4 or 5 quarters is one of the best EBITDA per wheel which we have received. And as we have indicated that once the mix tilts more towards alloys and more towards exports, this is expected to move up. So whether it will reach 300 or not, I guess it will take some time. It will not immediately, it will move from 260 odd levels to 300 odd level. But yes, the trajectory should be an upward trajectory.
So over a period of 3 years, we can assume that this is a possibility, right? 250
Again,
to moving closer to.
what kind of mix that we are doing, what kind of product that we are serving. So yes, so ideally trajectory should be upwards. So whether it will be 280 or 300, I guess that is to be seen.
Yes, this is it. Thank you and all the best.
Thanks.
Thank you. The next question is from the line of Nirav Shah from SSWL. Please go ahead. Mr. Nirav, your line has been unmuted. Please go ahead with your question.
I'm Nirav, sir. I just want to ask, did you get any new business of any wooden knuckles from India?
I think as we have discussed that knuckles business will start towards the Q3 of this financial year, and there are two large nominations which have already been given from two marquee customers of our alloy wheels. And this is for one customer, it is close import substitution. For second, it is local development and the full service support. And there are 4 more knuckle proposals which are going on in terms of development, which is from export as well as from domestic markets. And we are fairly very confident on this business of becoming like an alloy wheel business the way that it is happening over the.
I think within knuckle will be the turning point of your company.
So I think we have already turned the corner from 100 crore EBITDA to 500 crore EBITDA. Now to get to the next league where you move from this 500 crore to 700 crore EBITDA is where this kind of a business will obviously help. And we are fully committed to it.
Because you are only one player, so definitely it will be.
So our first mover advantage will definitely help. We are confident on that.
Yeah, I'm also confident in your company. But it will be go ahead.
Thank you.
Thank you. The next question is from the line of Bhavesh Jain from DW Investment Advisors. Please go ahead.
Hello, sir. Thank you for the opportunity. So, if I just look at the macro picture, like we are focusing more on the alloy wheel penetration. And if I look at the last quarter, we mentioned that there is high ventole wheels which OEMs are preferring. So can you throw some light on like what is the penetration of high ventole wheels and alloy wheels and the steel wheels, and like how is the picture shaping out?
So, when you talk about steel and alloy, first we'll talk about the bifurcation of steel and alloy. I think 36, 37, 38% is alloy wheels. Balance is steel wheels. So within the steel wheels, I think the penetration, which is 67%, 65%, I think very minute scale of high ventole has started taking up. So current juncture is at close to 10%. And we feel that it's not a very easy game to change from alloy to high ventole, and customers will expect that I will take it because obviously he's paying money to it. These are cost savings proposals coming from the customers, and the intention will be to fix mid trims, which is the mid models of the cars, not on alloy wheels but on high ventole wheels, which is where also we are there. And on the lower trim, which is the base models or maybe base plus 1, you will have steel wheels. And on the higher model, which is say, top 3 or 4 categories of the models, we'll have alloy wheels. So within this year, we expected that the alloy wheel penetration will move from say at 36-37% to maybe 39-40%, which has not happened in this financial year because of the cost pressures, or maybe the OEMs are not able to sell those cars in that numbers, and they are trying to have different kind of a connotation towards pleasing customers. But we are fairly confident with the industry moving towards heavier vehicles, sturdier vehicles and stylish vehicles. Alloy wheel penetration will continue to move up towards 45 to 50%. The largest alloy wheel car maker, which is Maruti, was at close to 20% of penetration and has already reached 33-34%. They are also indicating towards the movement towards 50%. So alloy wheel will definitely move up in terms of penetration, and steel wheel is where the fight between steel and the high ventole wheel is going to be there. So we feel that over a medium term, this penetration will cap around 15% of the steel wheel side.
Okay, sir. Thank you so much.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Aejas Lakhani from Unifi Capital. Please go ahead.
Yeah, hi. My question is more near term for FY25. Could you give some color directionally on how the EBITDA, per unit should shape up? Because you've just said, right, that knuckle casting will start, which is better from a margin perspective. And also juxtaposed to that is the fact that you said that ramp up will take time towards 5 million. So I'm just trying to understand in the context of, knuckle casting starting and the ramp up taking a little more time than anticipated, how EBITDA per unit or per wheel should be for FY25.
So from one second.
Yeah. So on the EBITDA per wheel side, so what we have done in Q1 is 257 rupees. So we expect, I guess, for the entire year will be somewhere between 255 to 260 rupees. On the knuckle part, yes, the knuckle will have a better margin profile, but if you look at in current year, as Mohan pointed out, as we be starting with knuckles, in current year we expected to sell almost 140,000 knuckles. In terms of revenue, this translates to almost 30 odd crores. So its contribution to the bottom line, at least for current year, will be much lower. Next year, this number is expected to get doubled, and then we'll take it from there. As Mohan indicated in his, I guess, initial query that he answered, that there is a definite amount of traction which is there in the market. We have already covered a couple of OEMs, and there are gradual interest which is coming up from other OEMs as well. In fact, there'll be an opportunity overseas as well, where we can probably export these knuckles. So based on how the market shape up, we'll probably look at adding further capacity. So for current year, I guess the EBITDA benchmark on a per wheel basis should hover between 255 to 260.
Got it. That's very clear. And when you call out the EBITDA per unit at 255 to 260, do you factor in the knuckle casting, or is that excluding the knuckle casting?
So see, knuckle in any case will not be a major contributor to the bottom line. So it will not make much of a difference. So because this is purely EBITDA per wheel, we will not cover knuckle in this.
Okay. Thanks for that. And on the AMW side, is it that, I think last quarter even called out that, you're moving the machinery, and so I just wanted to understand that, is it taking slightly longer than anticipated to kick off, all of this? And then when should we expect a ramp up or rather commissioning of all those facilities of AMW for which we've paid? Yeah.
So, see, as indicated in our last call, so the endeavor is to utilize those assets which are there within, irrespective where exactly they are located. And currently, looking at the size of that facility, we're in almost 7 to 8 million in terms of capacity. I guess it will not be prudent to run those capacities without first attaining a minimum order book size. So what we have done is, in fact, we have already started shifting those equipments to our plants in Jamshedpur and Chennai, and those are getting commissioned. I guess few of those equipment will need some repair as well. And as Mohan indicated, maybe by Q3 we should be up and ready with those brownfield capacities getting added in our Jamshedpur, and we'll start utilizing them immediately. And on a long-term basis, I guess we are already working on garnering further orders, both for the domestic as well as for the export side. And alternate set of businesses are also being explored, which includes your OTR and agri wheels.
Got it. And, because of the incremental debt that has been taken to finance this, the run rate that in finance cost that we have seen for this quarter, is that how we should sort of forecast FY25, or, will this sort of ramp up or increase?
No, so it should actually come down. So if you look at in our starting commentary where we have quoted our overall debt, so in FY24 Q4 end, we were almost at 1,050 crores in terms of the overall book debt which is there. The same number for Q1 end is hovering at around 965 odd crores. So there is already a reduction of 80 to 83 CR which is already seen. We expect that yes, Q1 we have seen a financial cost hovering at around 31 odd crores. I guess for the full year it should be somewhere between 105 to 110 odd crores.
Thanks and all the best.
Thanks.
Thank you. The next question is from the line of Vivek Tulshan from Newmark Capital. Please go ahead.
Hi. My question is on the export front and more a longer term trajectory. So if you look at last 3-4 years, our growth in exports have been quite impressive. But now that we have excess capacity both in steel and alloy, as we have commissioned our new plant, I'm just trying to understand what is the hindrance to ramping up the exports business in a big way. Is it that from a cost perspective, India is not as competitive as China or some of the other markets where wheels are getting supplied from, or is it that customers take time to empanel you as a supplier, and that is something that is taking time?
Yeah, so I think what world has seen in the last 4-5 years, I don't think anybody saw it post World War II. I mean, pandemic followed by the crisis in Ukraine and Russia. I mean, these are such big speed breakers in the overall economic growth of any region per se. So we if we put ourselves in the shoes of OEM customers, for them to make their procurement strategy, also they try to buy a little more time, ramping up new suppliers away from their domestic region. So if I'm sitting in Europe and if there is suddenly a war and then the costs are going up, the freight is going up, I take a little time instead of going all in a very, very expeditious way to introduce a supplier into their domain, which is away from them. So we have seen this happening, that the ramp up is taking time because of these big changes in the overall geopolitical situation across the globe. So I would factor those reasons as the real reasons why we are not seeing a very, very fast ramp up in our export segment. But having said that, the way India is poised in terms relations with US and Europe, I am very, very confident that exports will continue to contribute in much larger ratio in the coming years. So it will continue to grow. The only thing is that all these large factors that are happening around us, they do put some dampers.
So from a cost competitive perspective, how would you position us versus the global suppliers?
We are definitely amongst the most competitive suppliers today. I mean, if you talk about the manpower costs, even in Southeast Asia and countries like Vietnam and Thailand, forget about. But even these countries are reeling under high manpower cost of situation. Forget about what's happening in the developed economies. I'm not even talking about them. But even if you talk about Southeast Asia, or even if you talk about Mexico, the manpower costs are too high. The inflation is too high. Turkey, you see what's happening to Turkey. I mean, Europe is buying a lot of their commodity products from Turkey. But if you ask any European buyer today from the OEM perspective, they do not want to rely so much on Turkey because of how they are poised politically. I mean, so they are trying to survive. Turkey as a nation is just because their local currency has depreciated against the euro so much. But if you see the inflation, the spiral through which that country has gone in the last 36 months, nobody wants to build a long strategy on that country. So considering all these factors, India, forget about these odd freight increases that happen. They stay there for 3-4 months, but they go back. But largely speaking, we are pretty much stable nation in terms of our deliverables. So we are very, very optimistic considering that capability of our nation that we have.
God, this is helpful. Thank you. My next question is on the consolidated versus standalone numbers. So there is a 5 crore difference in the PAT between consol and standalone. Would it be fair to say that this is largely attributable to AMW and this will continue till we commercialize production at AMW?
Yes, so it is. So there are two aspects to it. One is the depreciation of AMW asset. I guess this amount is almost 3.5 crores. And the second is the day-to-day expenses, the routine expenses that we are incurring in AMW.
Got it. Okay, thank you.
Thank you. The next question is from the line of Chirag Shah from White Pine Investment Management Private Limited. Please go ahead.
Thanks for the opportunity again. Two questions. Firstly, sir, if you can just give a recap on AMW capacities that we have, effective capacities for next 2 years, because I think that they had tractor or off-highway tire capacity also. So if you can just give a broad indication, what commercial vehicles you indicated the plan that you have shifted 4 lakh units a month. So one, that is first, if you can just give a broad indication of the segment-wise capacity of AMW, which could be effectively used over the next 2 years.
So, the capacity is between 5 to 6 million, wherein one of the line, which is the tube type line, can produce close to 500,000, which is now getting shifted towards Jamshedpur. Then we have a tubeless line, which is going to be at close to 0.5 million again. And that is not used because we have Chennai plant and we are going to be sufficing that. As soon as this comes to a level where we are going to be at 80%, obviously this will come into act and we will start to utilize that. The other side is tractor capacity, which is at close to 0.5 million again, which is the upper plant is at close to 0.91 million kind of a number for tractor. We are at close to 85% utilized tractor there. And some of the debottlenecking is already happening in Dappar from these machines to increase the capacity of the Dappar plant. And then we have, apart from this 1.5 million, then we have 2 car lines which are available, close to 1.8, 2 million roundabout. So this is where the breakup of this 5.5 million is coming from. The car lines, which we anticipate with the industry growing at between 5 to 6%, will come into some of the utilization in financial year 25-26. I think right now Chennai is fully balanced at close to 85-90% utilized. Dappar is at close to 85% odd. Jamshedpur, in the current month it is not there, but for the full year I think it is utilized to the 85% odd. Chennai is at truck plant is at close to 65-70%, and next financial year, because of the volume growth, we anticipate some of the workings to be starting in AMW as well. So whether we do it in AMW or we do it in our existing plants by debottlenecking, that will be the choice based on the financial performance of the plant post operations.
And sir, just a clarity, so we already had some customers at AMW, right? Even in the export market.
No, so for AMW, we do not have any customers there. We have customers which are for SSWL. And we do not have any AMW customers where they were serving because the plant is shut for many, many years now.
Okay.
So those customers have already been taken up by Aditya's team in terms of SSWL to increase the market share, as Aditya has emphasized in terms of our future strategy towards OTR. This plant will be utilized where the team is already working.
Thanks for this. And sir, just a follow-up on the earlier question, the opportunity to India, the export opportunity. Just to understand it slightly better, why is it taking time for a product like wheel, a casting product like wheel? Because in auto ancillary, we have seen this shift happening. Even in some of the other industries, we are seeing shift happening because of anti-China plus cost issues in Europe plus geopolitical issues that you highlighted. So it appears in the wheel space it is taking a bit longer time. Is it that the wheel industry from India is a bit late to encash on this, or customer focus has not yet come on this, and when do you expect the tipping point to happen?
I think I'll take the first chance and then I'll ask Aditya to take it up. I think wheels is a very sensitive subject. It is a Maru A safety product. In the entire car, this wheel chassis assembly is the most sensitive. So do not take it just for the namesake कि वो mirror वाले ने कर लिया तो why wheels is not able to do it. It's a very sensitive decision to move one continent to other continent because it's a safety product. And at the same time, the validation of a vendor, the sustainability of the vendor and certification and ground certification takes time because the vehicle has to run certain amount of thousands of kilometers to ensure that it needs to be changed from China to India. It takes a bit of time. I think it is commendable that Aditya's team has taken up close to 250 odd crores to close to 700 crores worth of exports in a market where globally they grow at 1.5%. With COVID taking them down by 25-30%. So it's a commendable amount of improvement in exports. And it has its own pace. As I stated in my many calls, that alloy wheel market is a 350 million wheel market. India should target 10 million, 15 million over the next 5 years. Can SSWL supply 1 million, 2 million, 3 million in next 5 years is where the vision of the company is. So we are at 5 million. We will not stop at 5 million. We will go to 10 million. Out of that 10 million, yes, something will be domestic. Majority will be exports because that's where the playing ground is. In that exports, yes, there are challenges of geopolitics. There is challenges of duties. There is challenge of demographics. There is challenge of social unrest in those countries. So those challenges, I think Aditya and his team is taking care of. And anything that I've missed, Aditya, you can please add.
No, I think Mohan will cover.
Some of the other, in the auto ancillary also, some of the other critical components have seen a reasonable offtake from India. So I was coming from that perspective. And when do you see the tipping point? My more important question is, are we 2 years away? Are we 3 years away in your best guess or best estimate? I understand these are all estimates or guesstimates or in that sense. But where are we in that validation/approval process? That 2 years out could be the real tipping point for India as a place for wheel exports.
Sorry to interrupt you, sir. I request you to come back for a follow-up.
No, I'll answer that. No problem.
Okay.
So as a company and a sensible shareholders representative, I think it is very important for me to give a vision to the shareholders that we are at close to 4,500 odd crores. And we aspire to be $1 billion revenue at 8,500 odd crores, 8,000 crores in next coming 5 years. In that journey, export will play a very pivotal role because that's where the unseen market is. We are doing just 700 crores. Can we do 500 crores more? Can we do 1,000 crores more? Is where company is working in terms of the product development, which is on alloy, on steel, on trucks, on OTRs. At the same time, knuckle is another product which is going to add 500 crores, 700 crores, 800 crores is where the thought is. So broadly, we are inclined towards that kind of a number over coming 5 years, which is going to be coming organically from the domestic market, inorganically from the export market, and some of the cannibalization which is going to be happening from China plus one philosophy. So these three factors will run around. And I think with the auto ancillary volume business, I think indicated to be down by 2 to 5% this financial year. I think we'll be confident to take a volume growth as well as a value growth for financial year 24-25 is where my stand for the organization is.
No, fair point. Because your capabilities in India are far ahead than your peers. That's why I was asking this. What is the tipping point? Definitely your capabilities are far better than your peers, at least in India.
So it will take maybe 2 years for us to pace up whatever effort that the team is making right now, and the results will be visible.
Yes, thank you and all the best.
Thank you. The next question is from the line of Shashank Kanodia from ICICI Securities. Please go ahead.
Yes, sir. Good afternoon and thanks for the opportunity. So just wanted to check what will be your capex guidance for this year and next year, roughly?
Can you please repeat it?
So what will be our CapEx as in the capital expenditure guidance for this year and next year?
The total capex expenditure for this year will be around 210 to 220 CR, which includes knuckles and alloy wheel expansion, with the balance amount was pending.
Okay. And so next year could be tapered off, right? I think large part of CapEx will complete this year. So
Yeah, last part of CapEx will be completed within this year, and for next year, I don't think so. We are doing some of the major CapEx only except knuckles. Where if we want to increase the capacity, yes, we can add on capacity by doing some CapEx in knuckles.
Right. So next year we can expect something in the range of 50-20 crores, right?
So see, there is nothing significant which is there on table as of now for next year. I guess the knuckle might require something if there is an incremental demand coming in because of the kind of traction that we are seeing. But on an overall basis, I guess we are not seeing a capex of more than 70-80 odd crores, including the replacement and the balancing equipment.
Right, sir. And so secondly, on the debt side, so as you've been highlighting before also, so the peak debt is behind us, right? So now it's going to be a downward trajectory for us for next couple of years, right?
Yes. So the 1,050 crore that we saw last year will be the peak, and then now will be on the reduction part.
Right, understood, sir. And so in the initial remarks, you mentioned that the steel business is expected to grow 6 to 7% this year, and the aluminum business 12 to 15%, right? So blended basis, we could expect something like 19% kind of a top line growth for us this year?
No, so in terms of volume, I guess the overall growth will be hovering around 5 to 7%. And in terms of number, I guess we'll be somewhere around 20 million. In this 20 million, the export is expected to be around 4.2, 4.3 million.
Understood. And so responding to a previous participants, you mentioned that the key levers of growth will be organic domestic and inorganic exports. So by inorganic, you mentioned, are we indicating some kind of acquisitions or something of that sort, or it's just rising exports, normal exports?
So it will be normal export. There is no acquisition which is there on the table as of now.
Understood. Fine, sir. Thank you so much and wish you all.
So on the export front, I guess the number will be around 4 million. Like 3.7 billion is what we did last year. So this year we should be doing almost 4 million.
Understood. Sure, sir. Thank you so much.
Thank you. Ladies and gentlemen, we'll take this as the last question. I would now like to hand the conference over to the management for closing comments.
So thanks a lot for having us present ourselves and giving us an opportunity to explain the quarter. We are, as we have stated earlier, that company is committed towards improving the margin profile, improving the customer profile, and improving the product profile. We are fairly committed, and we feel that the effort that the company has done over the past 2 years in terms of NPD will start yielding results from this financial year end and will be fairly visible in 25-26. And the capex that we have done over the past 3-4 years will try to show its relevance to the shareholders in financial year 25-26. And once again, I thank all the participants for giving us this opportunity. Thanks a lot.
Thank you. On behalf of SMIPS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.